Hey everyone, welcome to another Few Good Minutes. So one of the things I wanted to address here was not only people asking me these questions, but also me seeing these conversations happening in the chat. So our Everything Money tool is awesome. And obviously the most popular part is our stock analyzer tool. Now, one of the things I want everybody to understand is how to really get the most out of it. So let's, pick a company. Obviously it's Baba's big for us. First thing, you pick number of years. Now, guys, I will repeat till I'm blue in the face. Your goal with any investment is to start with a 500-foot view. You can use stock analyzer tool in two ways. One, to initially screen. Say, I'm just going to pick some numbers and see if it's even worth me looking further into. And then point number two is, once you've determined you want to look into it and you've looked a ton into it and say, you know what, I have a pretty good feel for where I want to put my inputs, then you put it in there for your final numbers. So first, the one I'm going to concentrate on right now is the first method. Start with, okay, let's see if it's even in the ballpark. So look at Alibaba here. The 1 and 5 year numbers are 39 and 42% revenue growth. I've seen some people go higher than those numbers. That's not being conservative unless you have a real valid reason why the numbers should be higher. So for example, I would go to Baba and do 10, 15, and 20%. Now you might sit there and say, Paul, 10% so low. You're right. Okay, fine. Go to 15, 20, and 25% because it's still significantly lower than they did in the last 5 years. But just remember, when you're analyzing it, 25% revenue growth for the next 10 years would have them grow their revenue by 9 times in the next 10 years. That seems unlikely. So that's where I'd pare it back. Maybe I would do something like 13, 16, and 19% revenue growth. The goal here is to be somewhat conservative, somewhat aggressive on the initial stage to see if it's worth your time. Profit margin. Okay, last 5 years they've done 22%, but they did 15% last year. Let's go 18, 21, and 24%. Free cash flow margin. I tend to keep these the same unless I have a reason not to. Because remember, over long periods of time, free cash flow and earnings should be pretty similar. Now, PE. Guys, you know me. The bigger a company gets, the lower the PE. And the less growth potential they have, the lower the PE. And again, guys, I always do 12.5% return. Some do 15%, some do 10. But to me, you can get 10% from an ETF. So to make it worth your while, 12.5%, go higher with more uncertainty. Hit the analyze button. All green. What does this tell me? I'm going to look into this further. Now I want to do more deep research. That's the point of the stock analyzer tool on initial stage. You think it's too high? Go even lower. Do this. 8, 12, and 16% revenue growth. Still all green? Go do more research on it. That is the point of stock analyzer tool. The point is to get a starting point, and then once you have all your research done, after you decided to go further, to then go back in and say, what are my real assumptions on this investment? Thanks, guys.